we'll talk about entrepreneurship through the lens of tech startups, of venture-backed Silicon Valley tech startups. And we'll go through 10 steps that I think are probably the highest probability path to becoming a billionaire. So the goal of starting a tech company is not to become a billionaire. It's not to seek status. That's not my goal. I'm not a billionaire. I have not succeeded on this path. But I do think it is the highest probability way of becoming a billionaire. So there are people who follow this recipe who do become billionaires. So all paths to billionaire are low probability. But this is, I think, the highest probability path of any path you can take if your goal were to become a billionaire. Quickly on my background. So I'm 43. I started my first company when I was in high school. I then, at about 22, moved to Palo Alto. And I joined the founding team of a company called Reputation.com. That was the first venture-backed business I was a part of. So we raised about $100 million for that company. It's a unicorn today. It's $1 billion plus business today. I then was the non-founding CEO of a company called Euclid Analytics. And so this was a data company. We would tell retailers, like places you go shop, how long people stay in their stores and how often they come back. And we raised about $50 million to that company. And then I sold it to WeWork at the height of WeWork's. WeWork was the most valuable private company in the world at the time that we sold the company. It was a $44 billion, a private mark. That's different than a public company. A public company is worth $44 billion. It's actually liquid. You can trade the stock. Private companies get undervalued and they get overvalued all the time. In this case, it was overvalued. They were worth about $1 billion 6 months after they acquired the business. So the fortunes of tech companies can swing pretty wildly. Then after leaving there, I started a company called Most Days that has become Death Clock. And we've raised about $15 million for this company. The goal of Most Days was to help people change their habits, to improve their mental health, to improve the quality of their life. And we failed really miserably. Like basically we were spending $5 to get customers who were paying us $3 to simplify it. We were sticking $5 into the business machine and we were getting out $3. It was a bad trade. And so we did what's called a pivot. We had a couple $1 million left in the bank. And I went to my investors and I said, you can either have pennies on the dollar back. I've spent 10 million. We got a couple million left. Or I can try this idea. And the way I pitched this idea was, yeah, it's an AI doctor. It's AI preventative health. It's going to solve the preventative health problem that we have in this country. And you say all that before you tell them that you want to call it Death Clock. And I thought Death Clock's either the worst decision I've ever made in my career. It probably is the worst in terms of just a career decision, or it's the best. And it's been going really well. And so we'll talk about like what there is. I'm not here to talk about Death Clock, but there are some learnings in the story of going from like, oh, we just flushed $10 million down the drain to like, let's try something new. And then it starts to work. Oh, here it is. So the first thing about, and this is very specific, there are entrepreneurs of all kinds, right? So this is going to be very specific to being a tech entrepreneur and very specific to being a venture-backed tech entrepreneur. The cool thing about being venture-backed is that you're growing your business with other people's money, right? So, you know, the $15 million that's in this business, that's not my money. That is other people's money. And if we fail, we don't have to pay it back. And actually, you can fail. Somebody can give you $10, $15 million, and you can still raise money again. That's pretty common. So there's kind of a wonderful venture ecosystem in this country. But the first thing you want to make sure, and you want to ask yourself is like, do you actually want to be an entrepreneur? Because it's a very hard road. So this is my family. And at the time I created this slide, I gave this talk in this class last year, I wasn't paying myself, or I tried not to pay myself. What's funny about, I had been paying myself, and then the company was doing really poorly, and it looked like we were going to fail. And I went to our lawyers and said, hey, I'm not going to pay myself, so we can extend the burn, so we have more money, and we have more time to kind of figure out the company. And what's funny is they said, no, you're not allowed to do that. You have to pay yourself minimum wage. I was okay, and so I paid myself minimum wage. But, you know, This is my wife. She's actually here. She works at a public tech company. She works at Dropbox, and she makes many times what I make. Like her income is 5, 6, 7x higher than my income in terms of her cash. And then these three mooches do nothing, contribute nothing, and they just suck resources. But our family is a good example of the paths that you might have if you're thinking about technology and you're thinking about entrepreneurship. And so in Silicon Valley, the vast majority of the millionaires that have been created in Silicon Valley have not been created by founders. It's not the people starting the company. If you look at the billionaires, that's going to be majority people who started the companies. But the vast majority of the millionaires are people who started companies that already existed, they joined companies that already existed, and then they worked their way up in those companies. And in Silicon Valley companies, you get equity. You own a piece of the business, even if you're not the person who started the business. And so the people who have really taken a high probability path, so a low risk path, and made a lot of money in Silicon Valley, they're not the people who started the companies. They joined something once it was already working, and then it grew while they were there, and their equity became worth much more money, right? Maybe the company was worth $10 million and they joined, and then when they left, it was worth $100 million. So they made money that way. Then they went to another company where the same thing happened. They worked at public companies, like my wife works at Dropbox. It's a public company that was once a startup, but the public companies, they pay a lot more. It's cash. They pay a lot more in terms of your base salary, and they pay a lot more in terms of equity. But when it's a public company and you get equity, you can sell that equity. It's a stock that you can sell. In a private company like Death Clock, I have equity, I have shares, options in the business, but I can't sell them. It's illiquid. There's no stock market for me to sell them on. And so you got to really decide like what your goal seek is and what you want to do. My wife, she works with a lot of really smart people. She works really hard, but she doesn't own the business. It's not existential to her, the success or the failure of the business. And so she sleeps better than I do. She makes more money than I do. It's challenging. It's not that it's not challenging, but it's a different kind of stress that you have to carry. And there's kind of no wrong answer here. Now, as the founder, I'm not able to pay myself even close to what a public company could pay me. But if I win in a really big way. So I'm choosing a part of the risk-reward spectrum where there's a lot of risk, but also a lot of reward. Like if our family, if we ever do become billionaires, it's going to be because of my work. If we ensure that we always have enough money to retire on and we have comfortable lives, it's going to be because of her work, right? So she's got a much safer path than I do. And it's nice actually to marry somebody like that because you balance out the risk. But the path of being an entrepreneur, it's a hard path. And so you want to make sure if you're like, hey, I want to be an entrepreneur, I want to start a business, that you actually want that. Because starting it because you want to be a billionaire or because you want some status or something, that's not going to sustain you. It's a really, really hard ride. So you really got to ask yourself, like, where do I want to be in terms of my career and what do I want out of my career? The second step is, and this is going to be true, this is true, it's San Francisco specific for tech, but basically when you graduate, if you want to be a tech entrepreneur, just move to San Francisco. Something will work out. You want to go to the center of the universe for whatever you're doing, because all of our careers are some combination hard work and luck. And you want to put yourself in a place where there's more luck, where there's just easier to get luckier. And that for tech is San Francisco far and away. And San Francisco is a very unique place in the world. It is the top place for entrepreneurship anywhere in the world, right? And we just happen to be like a couple hour flight from it. But also in the history of humanity, there's nowhere better to be. Maybe you'd compare it to Renaissance Florence or something, and the Medici family was paying artists and inventors to do things. At nowhere near the scale. You can walk down a random street in San Francisco and it's just billion-dollar companies on both sides of the street, kind of as far as the eye can see. It's a slight exaggeration, But there are blocks in San Francisco where there are more billion-dollar companies than there are in all of Colorado, Wyoming, Utah combined. It's a really unique place. And your career and your lives to a larger extent than you'd like are going to be defined by the people who you spend most time around. There's this kind of saying that like the 5 people who you spend most time around are gonna have a much greater impact on your life than your parents and then a whole bunch of other different factors. So what happens is San Francisco is a lot like, I don't know, the US. Like people from all over the world came to the US and with a dream and they took some risk and they created this place. It's kind of like that. You have all these people like, I want to do that. I want to start something. I want to change the world. I want to make money. And so I'm going to go there. And when you aggregate a bunch of people who have a kind of similar mindset about that in the same place, just really good things happen. And then there's a ton of capital there. And the capital prefers people who are there. But anybody in this room can raise $1 million to start a company. Anybody. When I first moved to Palo Alto, I had been kicked out of high school. I couldn't tell you if I graduated from high school. I'd been kicked out after I got into college, and so I just showed up at college and hoped they wouldn't know. Didn't matter. I dropped out of college anyways, and I've kind of been in the school of hard knocks doing this. So, and San Francisco and the investors around there, they are built around like they're fertile ground for people in their early to mid 20s to have an idea and get money to go pursue that idea. And if somebody gives you $1 million, $3 million, $10 million, it happens every day to people in their mid 20s. And you fail, it's okay. As long as you don't lie, as long as you try to make the money work, it's okay. So it's a really incredible place. I mean, people lose hundreds of millions of dollars and then their companies fail and they raise again. And so it's a place that's incredibly tolerant of failure because that's part of the business model that we'll talk about. So first step is make sure that you actually want to be an entrepreneur. And then probably the highest impact thing you can do for your career if you want to be an entrepreneur or you want to be in tech is just move to the Bay Area. And it's nice because the Bay Area is pretty nice. Like if we were giving this talk, in like, I don't know, 1935 or something, like move to Detroit. And like nothing against Detroit, but the Bay Area is really nice. It's a nice place to live. So I don't mean to knock Detroit too much, but San Francisco is nicer than Detroit. Okay, the third step is you've got to have the right founding team. So you can go to San Francisco, you can get $1 million to start your project on just a deck. You don't need to really have anything of substance. But in order to increase the odds that you're successful in getting somebody else to give you their money for you to go pursue your idea, you want to set yourself up for success. And what that means is having a 2-person team, so 2 co-founders who equally split the business. You start your journey at 50-50. You want one of you to be technical. Now, the beauty is if you're not technical co-founders are looking for non-technical co-founders. So this is Steve Jobs and Steve Wozniak. Woz was the technical co-founder. He was the one who was building the computers in the early days. He was the tinkerer, kind of the nerdy guy. And Steve Jobs, he's the salesperson, he's the business person, he's the marketer. And the beauty of this is it's a symbiotic relationship. Wozniak doesn't want to run around and sell these things and talk at the trade show and figure out how to get investors to give him money. And Steve doesn't want to build them. He wants to be out selling. And so they both have a unique skill set and there's a 1 + 1 = 3 thing there. But the mistake that you don't want to make is you want to be careful about being a solo founder. It's a very lonely journey. It's a hard journey. It's good to have somebody to share the journey and to bounce ideas off of and for somebody to give you feedback. So you want to have 2 founders and then you want to make sure they're not both business. You need to have somebody to convince investors that like you can actually build something. Because at the very beginning when you're raising money, you're just going to have a deck and you won't have actually built anything. And so they need to believe that like actually you can build something. And that's hard for 2 people who are non-technical. And then there's also something about the founder status. Even if you can hire those people, which you can, you want somebody who's technical, bought into the business at a founder level, who has a really significant amount of equity and really has a large stake in whether or not the business fails or succeeds. So the top incubators like Y Combinator these are businesses that basically they take a small percentage of your company for a small check, and then you spend 3 months with a group of other startups trying to get your startups off the ground, basically. They're going to prefer the one-on-one, or you can get away with too technical. If it's too technical, people, you can get away with it. But this kind of tends to be the best profile. Okay, so the other thing you want to understand if you're saying, I want to do a Silicon Valley tech company, is you've got to understand the game that you're playing. So you are playing a game where your goal is to hit grand slams or strike out. You're taking big swings and you're trying to hit it over the fence while the bases are loaded, if we stick to that analogy, or strike out. Because singles and doubles, the business model doesn't work with singles and doubles. So if somebody gives you $1 million and then you spend 5 years building your business and then you return $2 million, that doesn't really matter to them in terms of their fund. It's not going to make or break their fund. Sure, $2 million is better than zero, but they need the whole fund to win. They've raised a pool of capital. So let's say they raised $100 million to give to people like you. They need at least one of those companies to return in a non-linear way, to return in an exponential way. I gave you $1 million and I got back $100 million. They call that a fund returner, right? And there are examples of checks into Google and stuff. Somebody wrote a 250K check into Google and now that 250 is worth, 30 billion or whatever. They probably sold along the way, but it's a power law game. And so what that means is you have to have a big idea. You have to have an idea that if it works, it really works. It can't be like, oh, if this works, it's just like, yeah, it's like a nice little business, because that breaks the business model here. It'll often be 1 or 2 deals in a fund that can be considered a good fund, that make the fund. All the investments fail except for one, but that one it won in such a big way that it returns the fund. It makes the whole fund worth it. So you got to make sure that your idea is venture worthy, that it has that kind of characteristic, that if it works, it's going to work in a really big way, because the business model of your investors only care about this. All this stuff, and you might make money in here, which is interesting. Like the entrepreneur can make money even though the investors aren't that happy. It can be meaningful to you individually, even though it's not to the investor. So fine if you end up in that place, like it just is what it is. Everybody who's doing this, they're adults. But to get the check in the first place, you've got to have an idea that they can believe, like if it goes right, it'll really go right. There's a very famous venture capital firm called Benchmark, and in their partner meetings, so it's a group of people who make the investment decisions, they ask the question, hey, what could go right? It's very easy with these businesses to talk about what could go wrong. They, like 90% of them die. That's a really simple conversation to have. But what's more interesting is you say, oh, what could go right? Like what happens if this is true? Like think of the example of Uber. Uber was an insane idea. People thought there's no way that somebody's going to get into a stranger's car. Like that's just not going to happen. That's going to freak everybody out, and like somebody's going to get murdered, and the whole thing is like, that's just not going to happen. You need all these crazy network effects. But if you ask yourself like, wait, what could go right? Like most cars aren't used most of the time. There's a whole bunch of people who don't have full-time jobs, but they do want to work. You could probably have a network of these that would drive down the cost of taking a ride somewhere. They could be available kind of anywhere. You don't need the whole medallion and taxis, system. And so when you ask yourself what could work there, it's like, well, if it works in a really big way. Even though at the time Uber was raising money, it's like, this is definitely like not going to work. That's a very easy argument to make that it's not going to work. And all these things look so obvious in hindsight. So understand the game that you're playing. You've got to have a compelling vision if it works. But you want to start with a small niche. So these things are kind of these two ideas are competing with one another. And so, this is the Amazon example. I think this is Jeff's first desk. Amazon really just focused on online distribution of books. They didn't focus on AWS. They've kind of become the everything store. They didn't have Amazon Prime. They said, hey, let's go into this category. It's going to be very easy to ship these. We think we can sell these online. It's the beginning of the internet. And they went and they dominated books, and then they expanded. So you have this big vision of what could go right, but then you've got to start with a very small niche. And so there's a crude metaphor here, which is startups die of suicide and not of murder. And what that means is when you start a company, it's like very easy to obsess over competitors and other people are going to do things and they're going to beat us at what we're doing. But the primary way that startups die is self-inflicted wounds. And those wounds are typically kind of twofold. One is bad founder relationships. You have two co-founders who don't get along. And basically like there's a divorce in the company. And then the second, and I think the more common way, is you die through lack of focus. You're just working on too many things. You're trying to boil the ocean. And so what happens is you become as a company jack of all trades and master of none. So actually the beginning of a company is really important, that you're identifying something that probably seems pretty small and pretty niche, like eBay. I'm going to date myself with some of these examples. They started with like little like collectible figurines and these very niche communities, and they were selling collectible figurines, and then they expand out beyond that. Amazon starts with books. You can kind of go anywhere. Think about where Facebook started. Facebook started just at Harvard. And then they added a few other Ivy or Ivy equivalents, and then they went to all college students. Like you guys are too young to remember this, but it used to be you had to have a .edu address to sign up for Facebook, and like dropouts like me were like bummed and hated it, and like, yeah, screw Facebook. And then they expand, and now like, you know, half the planet has a Facebook account. And so you start in a really niche way so that you can concentrate your forces, if we use like a battle analogy, in one particular location so that you can make progress across like a pretty simple problem. Then you demonstrate that progress to the people that you're raising money from, and then you slowly expand from there. If Facebook had started and said, yeah, it's going to be the social network for the entire world, we wouldn't know the name Facebook. We wouldn't have ever heard of Mark Zuckerberg, right? You had a big vision. If it works, we can connect the whole world together, and we can take these offline social graphs. We all know each other, and we can put those online. But where he started was like, let's just make this thing work at Harvard. And then, okay, and then you expand from there. And so you really want to remember that adage of, okay, most startups die from a self-inflicted wound, and that self-inflicted wound is make sure you got a good co-founder, but focus. If you spread yourself too thin across too many things and you don't make any progress across any of those, you're going to make very little progress across a bunch of vectors, and the thing's just like never going to get moving. So big vision, but you start really small and really narrow. And one of the things they'll talk about with this niche, you'll hear this word total addressable market. That's like how many people in the world exist that could buy this product or service. Forget all that as it relates to this. You don't care what the TAM is. Smaller the TAM, the better, frankly, with where you start, because you got a better chance of going and finding customers who are really into it and kind of dominating a little niche and then expanding. On the big vision, you want to have a nice TAM, but you kind of don't care. That's kind of like the advice, like you might, you'll hear somebody give you bad advice wrong. Oh, what's the TAM? You got to know what the TAM is. It's like, yes, you do, but like where you start, what's the TAM of Harvard people at Harvard who want a social network? I don't know. It's nothing. It's a total addressable market that's very small, yet that led to the $3 trillion company that we have today. So you want to start small, and you want to focus your energy and your resources. Questions? Okay, I'll keep moving. Okay, step 5 is, so there's another adage, and there's kind of Silicon Valley entrepreneurs say this, which is first-time founders focus on product, second-time founders focus on distribution. I'll talk about this third one in a second. And so what that means is when you found your first company, you're like, I just want to make sure the product is really good. So I'll give you the example from Most Days. Most Days was an app, help you change your habits to improve mental health, physical health. And I was just, we as a team and me specifically, were just hyper focused. If we want to build a really great product, and if we build a really great product, like the rest will come. Everything else will work its way out. And we spent about 4 years building a great product that a few people really liked, but we could never figure out how to market it. So the annoying thing about startups is you have to be really good at two things. You have to be good at product and you have to be good at marketing. And those are hard enough skill sets in and of themselves, but you've got to make both of them work. And so what this means is when you found a business the second time, you're like, yeah, the big mistake that I made was I just focused way too much on the product and I didn't think enough about the distribution. What that means is like, how are you going to sell this product? How are you going to get in front of the businesses you want as customers? You know, in the case of Death Clock, how are you going to get in front of the consumers that you want as customers? And distribution, I mean, they're both really hard, but I think figuring out distribution is actually harder than figuring out product. If you can figure out distribution, you can get the product right, but not everybody who figures out the product can get distribution right. And the combination of these two things is something called product market fit. And product market fit is like this mythical, elusive thing that is, when you have it, it's like wearing the ring and it's incredible and everything is working and you're growing like crazy. But when you don't have it, you see a lack of product market fit everywhere and you're desperate to find it. And just because you found it once, there are entrepreneurs who like had these huge billion-dollar outcomes and created these amazing companies, and then they just don't, they start another one and they don't find product market fit. And so the classic question is, what is product market fit? And it's very hard to define. So I'll give you a crude analogy on this, but I think it's a helpful analogy. So there was a Supreme Court case in the 1990s that was wrestling with the question of how do you define porn? And the judge who ruled on the case said, I don't know how you define it, but I know it when I see it. And I think they were trying to figure out like, hey, what's the difference between like a sex scene in an R-rated movie and pornography? And product market fit is kind of that way. You can't really define it. You can't say, oh, it's growth of this, or it's exactly when A, B, and C happen. But you know it when you see it, you feel it. You're kind of drowning in inbound. You got new customers and you don't even know where they're coming from, and you're trying to keep up with growth. You kind of can't manage the growth. And now how you know you don't have product market fit, like if that's not happening, yeah, you're getting some customers, a few are happy, but every customer is really hard. And it's just it's not feeling like you're purely in that reactive mode. And so this concept of product market fit is really important. And that's just the combination of having both of these first two things right. And then if you have all three, which is you're growing like crazy, the users love the product, the customers love the product, and they stay, okay, now you're on the kind of like proper billionaire path when you have all three. You can build really interesting businesses with just one and two, with product market fit. You can raise a lot of money when you have product market fit. But when you have all three, you're really winning. And so the goal at the beginning of the company, you raise the $1 million, you're like, what am I doing in San Francisco? You've got your co-founder, is not being wedded to your idea and just iterating on it enough out in the world that you find product market fit. Because then if you find product market fit, then you're just kind of keeping up, you're reacting, and you can learn all the skills you need to learn on the fly. So San Francisco in this game, it's built for people in their mid-20s. It's meant for people in their big 20s. It's a huge, billions of dollars sitting there waiting for people in their mid-20s to have good ideas and for those checks to be written. And the beauty about product market fit is you can learn on the fly, because at the beginning of your career, you don't really have much. You don't have experience. You're not like born to start companies. Nobody is. But you learn, you go and you iterate, you take some risk, you find product market fit, and then you just teach yourself on the fly. Mark Zuckerberg wasn't born, and he's kind of unusually talented. Maybe he's a bad example, but like he wasn't born knowing how to do this. He learned on the fly and he made a whole bunch of mistakes. His first business card said, "I'm the CEO, bitch." You know, like that's not what his business card says now, you know? not that he has a business card, but like he made tons of mistakes along the way, and that's what everybody does. You learn on the fly, and the best teacher of all is probably failure and struggle, number one, and then product market fit, number two, because you have no choice but to figure it out, and it's fun. The thing has a momentum of its own. And people at 22, 23 years old, they find product market fit every day. And there's some guy like me who's like a multi-time founder who's like toiling away and not finding product market fit. So it's not necessarily a game that favors experience or favors age. In some cases, if it does favor one or the other, it favors a lack of experience. You're naive. You believe the thing can work. You don't have all these, like, we're about to have our fourth kid. You don't have all these real kind of crazy real world things that you're concerned about if things fail. So, you know, you guys are in this kind of, you're coming into this very perfect time of your lives and your careers to be the ones who are out in the world making this change. And your goal is just to go raise a little money and find product market fit, and the rest of it will work out. But product market fit being the mythical beast that it is easier said than done.
Okay. I have a question.
Yeah.
So mine. So you have experience with both business to business businesses and business to customer business. Do you see any difference between the two in terms of what you were saying, focusing on distribution, small from niche markets, or are they the same for an entrepreneur?
No, they're not the same. So, okay, B2B and B2C, business to business, you are a company selling to other companies, or B2C, like Death Clock, you can download the app on the App Store. We're trying to get consumers to sign up, right? Apple is primarily a consumer company. Oracle is primarily a B2B business. So they're both hard. I would say I think B2B businesses are easier than consumer businesses. Consumers are fickle. It's a very noisy environment to get people's attention in. They tend not to retain well. They tend not to want to pay it. You know, they don't pay at the same rate. But the biggest businesses in the world are consumer businesses. So it's harder to make a consumer business work, but if you do make it work, it tends to be bigger than the B2B businesses. So again, think about Apple. B2B is, it's just a very different game. So let me give you so on Death Clock, we're very focused on virality and we're very focused on PR. We're very focused on like the average person becoming aware of us and hearing us. And what Death Clock is, it's an AI private doctor. So we really believe in a post-AI era that you should have a place to centralize all of your health data, and then you should have an AI that's basically telling you how to be healthy because our healthcare system is really bad at that. Okay. So we want to sell that directly to consumers, and we need to make a lot of noise. Maybe at the Buffs game, we need to have them like talking about us over the loudspeaker or whatever. You know, we want to get press. We want to show up on the news, et cetera. Building a B2B business is very much like you're using relationships to go get pilots with businesses, and then you are working very closely with those businesses to demonstrate the value of what you're providing. In doing that, you're learning what the customers want and don't want, and then you're iterating on the product and you're doing it again. So it's much more hand-to-hand combat where you're doing it through relationship. You're very, very close to the customer. On Death Clock, it's more of an analytical game. Like we talk to a lot of users, but like during the course of giving this talk, we'll have 50 people sign up for Death Clock, you know, so that's just a very different game. You'll never have that in the context of B2B. So probably higher likelihood of success in B2B, but it's a little less sexy. You know, it's like, oh, it's Death Clock, and like we're going on the news, and you know, it's fun if you can make a consumer thing like your friends and family can use work. But it's very, very hard. And there's a lot more money available for B2B startups than there is for consumer startups. A lot of consumer startups fail. That helpful?
Of course.
Okay, so the other thing about being successful as a tech entrepreneur is you have to be contrarian and right. And now the problem with being contrarian, so believing something that not everybody else believes, is contrarians are typically wrong. You know, the wisdom of crowds can be pretty good. People tend to all believe a certain thing for good reason. That's not always true, and that's where this comes in. But you have to be contrarian and right. If we go back to the example of Uber, that was not an obvious idea. Travis, the founder, Garrett, there's a guy named Garrett, I think is a real founder, but let's say Travis and Garrett, when they're running around and pitching the idea of Uber, you're getting a lot of, that's stupid. Like, that's never going to work. No, that's stupid. And when you go out and raise money, a good hit rate is like a couple term sheets out of 50 pitches. So you get 48 no's and then 2 yeses would be a pretty good fundraise. So you just have to not care what people think. You got to realize that, like, hey, I'll be proven right or wrong over the fullness of time. And I'm probably wrong, but I don't care. I believe in it. I'm going to go run. Because if you're running around and everybody's saying, yeah, you're right. Well, 100 companies are going to get funded, or there's already a bunch of companies funded. The market's going to get chopped up into a bunch of little pieces. For whatever reason, it's not going to work. Like, consensus ideas are not interesting ideas from a Silicon Valley tech perspective. So you really, frankly, if people are telling you your idea isn't very good, you're probably onto something more than somebody saying, oh, it's amazing. Every conversation somebody says that's amazing. You got to see the future accurately in a way that most other people don't. The second thing I would say here is, I think it's a Danish saying, I'm probably getting the origin of it wrong, but there's a saying that the tallest poppy gets cut down. And what that means is, when you're really confident and you're out pushing your idea, and if you have success raising a little bit of money, you get $1 million, the people around you who are not in that circumstance, they're going to take shots at you. They're going to say little things under their breath, or they're going to tell you it's not going to work. In a lot of cases, they're probably hoping it doesn't work. They want you to get brought back down to size. They don't like that you and your poppy has outgrown the rest of the poppies. Well, screw them. That says more about them than it does about you, and that just is what it is. It's kind of the price of putting yourself out there, and it's the price of succeeding. So you have to get really comfortable, like, looking stupid. You know, I'm in the prime of my career, and I'm like kind of toiling away in obscurity with a small group of people. It brings up a lot of insecurity for me, right? I could be doing like a fancier job, and I could be doing something better, and I could be doing something where I don't have to be on LinkedIn talking about death clock, you know, but it's like, hey, I believe in this thing. I want to make this thing work, and I don't care about my ego. Like, we'll see what happens. I'm putting myself out there. It's not the safest path. And if you want to try to come cut down the poppy, like, fine, that says more about you than it does about me. And so these are inherently risky businesses. And when we say that, it's like, it's real risk. Like, I'm risking real money. I'm risking my reputation. I'm definitely risking my health. Like, I don't sleep that well. Like, it's a hard job. And so one of those things is you got to risk looking stupid. And then the other thing is you got to be unashamed to go out and ask for what you need. Ask for help, ask for introductions. Who cares? You're the aggressive, annoying person who's trying to go meet with whoever. Who cares? And at the end of the day, there's like a game recognized game thing here, where like people who have also tried to be the tallest poppy, they recognize when somebody else is doing something that's like hard and courageous. And being in your 20s, you also have this advantage of, like, people want to help you. People want to help young people, and you take advantage of that as long as you can. Because when you're my age, nobody cares about helping you. You know, it's not the same. And so you want to go out, you want to ask the world for what you want to be aggressive in testing your ideas. But also you got to be responsive. Like, if you're getting good feedback that, like, hey, you might not want to think about your idea. You might want to think about more in this way than that way, and it sounds smart to you. You know, take it in. It's not that you ignore all feedback, but you got to have a thick skin. And I can tell you, if you're somebody like me, entrepreneurs tend to like have thick skins, but be pretty sensitive. You know, it hurts. It's not like it doesn't hurt. You know, like every time I get rejected, and as long as I've been doing this, it hurts. I'm just like used to the pain, you know, but it's not like it doesn't hurt. It still sucks every single time. So you just got to say, hey, I don't care. I'm going to look stupid a whole bunch. And that's how you know you're doing it right. This one I feel like is falling out of, I still believe it, but I feel like it's falling out of favor a little bit. I think if you choose the path of being a founder, you got to forget about work-life balance. And I think your 20s, I basically devoted the entirety of my 20s, not as much as Bill did, to like grinding away and working hard. Now, it was really fun. I had moved, so I dropped out. I dropped out of college at 22. I went to rehab. I couldn't stop smoking weed. And then I got out of there and I was like, I'm going to Palo Alto. And I moved to Palo Alto in 2005. And I found a group of people who were like me. They were like a little bit like delusional about themselves and what they were going to do in the world. And we all worked like 80 hours a week together. And it was really hard. And it was a lot of like long nights and working weekends and stuff. We were in it together and we were doing it for ourselves. And it was one of the best times of my life. But I wouldn't have had any success. I'm not the most successful entrepreneur you've ever met or the least. But any success I have can be attributed really to a couple of things. One, moving to Palo Alto in 2005 is probably number one. Just being in a place at that time. Facebook had just started and you'd go to these crazy like parties at Facebook. You see a bunch of young people, all people like your guys' age, like just trying to start something and trying to do something. And then just working really hard, because what happens is life is a series of investments and that compound over time, right? Like my wife and I are about to have our fourth kid, our family, the value of that and the benefit we get out of that is compounding over time. Careers compound over time. So when you put yourself on an interesting trajectory early in your career, that extends out through the rest of your career, right? It's like if we took off from here in Boulder and we were flying to New York and we pointed the plane just slightly left or right, well, it would end up in a totally different place based on where we pointed it. And so careers are like that as well. So if you really invest in getting ahead in your 20s, that compounds throughout the rest of your career. So I do think that I still think I wouldn't give you this advice if I didn't think it was reasonable. It's like, I don't know, move to San Francisco and have no work-life balance. It's a lot more fun than it sounds. You're with a bunch of other people doing the same thing. And there's a Freud or somebody who says it's the years of struggle that you remember most fondly. You go grind it out, you're learning, you're figuring it out. And almost everybody who moves there, they do it and they succeed in one way or another. They never succeed in the way that they would predict, but they succeed in one way or another. And all of the greats, not that the goal is to be Bill Gates, he's a complicated guy, but he didn't take a day off in his 20s. And I don't think this is his quote, but I think it's true. You talk to his, I think now ex-wife, or you talk to the people who were there at the time, it's like, oh yeah, Bill just worked Christmas. He just worked every single day. And so that kind of work does compound. Now I'm glad I'm not like this now. I've got kids and whatever. It's harder to do as you get older as well. But you kind of do want to and just surrender the suffering and the grind, and go see if you can't build something great. Okay, so the next step is, okay, you've and you can do this from, you can start businesses from anywhere, but let's stick with the step-by-step process. You've decided you want to be an entrepreneur. You move to San Francisco. You raise a little bit of money. You're grinding away with a small group of people. What you're doing is you're just maniacally focusing on what we talked about, which is product market fit. So this is Andy Ratcliffe, who's one of the founders of this firm, Benchmark Capital. They're one of the most successful venture firms ever. And so their first fund, it was a group of ragtag's probably the wrong word, but kind of maverick guys who left different firms and joined together. Their first fund was an $85 million fund and it returned $7.8 billion, the first fund. And so it's this legendary group of people who have funded all these amazing companies. And Andy Ratcliffe has this saying, when a great team meets a lousy market, the market wins, which means basically if your idea is no good, it doesn't matter how good you are. If the world doesn't want the thing, it doesn't matter. And that's why you see these incredibly experienced teams come together, raise a bunch of money, and fail. It happens all the time. But when lousy teams meet a great market, the market wins. So this is what we're talking about, where there's this 20-something advantage here, because you don't need to be the person with 20 years experience doing startups, et cetera. If you've got a good idea and the world wants what you're selling, you'll figure out how to make it work. The story in Silicon Valley of a company having a lot of success and being terribly run is way more common than the story of companies having a lot of success and being really well run. Like if you go look at the average company in Silicon Valley that's quote unquote succeeding, and you talk to the people in that company, everybody be like, it's a total mess here. Like it's a mess. Nobody knows what they're doing. The CEO doesn't know what they're doing. The management doesn't know what they're doing. The investors are idiots. But the company's succeeding because the market wants it. And so you don't have experience, you haven't done this before, it doesn't matter. If you have that alignment with the market wins. Because at the beginning of your career, you kind of are lousy. You know, and so, but that's the beauty of this is it just doesn't matter. Product market fit, Andy Ratcliffe. Now, the other argument that we could talk about here is what matters more. Does the idea matter or the execution matter? Like if you're good at making something real, the execution, or is it the idea is so good? And that's a tougher one. There are two famous partners at this firm who have different opinions on this. Some feel like, hey, all that matters is the idea. The idea of Uber is just so good that it doesn't matter. Like we can kind of figure out we can figure out how to run that business. The opposite side of this argument is ideas are a dime a dozen. Anybody can have an idea. Who cares? So I don't really have an opinion on that. I tend to think execution matters more than people think. But your goal is maniacally focusing on finding product market fit. And now let me go back here. The thing about product market fit is what you want to do is you want to make sure that you're iterating and that you're not blind to the reality on the field. So with most days, when we pivoted, we spent $10 million and 4 years working on something. And it was kind of obvious it wasn't going to work maybe after a couple of years. But it's very hard to let go of the idea. You really invested in what you've been doing. So you want to iterate. The founder of Ring, the cameras that sit on our front doors, he's famous for taking this approach of he started something, ran it for 12 months, and if it wasn't just ripping, then he would shut it down or sell it. And he did that like 4 or 5 times, and then Ring, and he sold it to Amazon for $1 billion, and he's like on Super Bowl commercials, but he just took this approach of like, I got an idea, if it didn't work quickly, rip it out, get rid of it, do another one. And so when you're focusing on finding product market fit, you got to constantly be trying new ideas. We threw away the entire Most Days app and we created this new Death Clock app, and then Death Clock worked, and it worked quickly. And things that are going to work, they tend to work pretty quickly. If you hear stories of like it took 5 years and then it worked, like you might with Most Days and Death Clock, it's like, well, yeah, we shut it down and then we started it totally fresh and then it worked quickly. It's not like we just grinded on the same thing for 5 years and it suddenly started working in the 5th year. So you're just iterating and you're just maniacally focused on product market fit, which again, you'll know it when you see it. Hard to define. Okay, any questions? Okay, anybody in this room can raise $1 million, at least. So this is kind of the toughest part of the startup curve. So think about startups raising money as you raise a little bit of friends and family, then there's a pre-seed, then there's a seed, then there's a Series A. The vast majority of companies will never get here. And then you'll hear Series B, Series C, Series D. Those are companies that are more mature. So as the business works and as the business grows, you can raise more and more money. And so what you want to do here is you really start with like begging like friends and family for money. But this means you got to beg in a very methodical and surgical way. You only want to take money from people who can afford to lose it, because you are probably going to lose their money. Don't go ask grandma for her last 25K. You want people who they understand it. They want you to win. They're going to give you the 25, the 50K. There's a whole bunch of professional seed investors here. Like I've had multiple meetings in my career where you're like, it's like a 10-minute call and somebody's like, sure, I can only do 100. Is that good? And you're like, sure. And just kind of toss it on. And for them, they're just writing a lot of checks. They think most of the checks will fail, but one of them will succeed. It's hard for them to determine which will succeed. So you check a couple of boxes in their head and they give you the 100K. So the other thing to remember here, again, take advantage of your youth. The big law firms, there's 4 big law firms in Silicon Valley. They will work for you for free. They will defer fees of up to 50K. And if you never raise and if you fail, you just never pay them. And that's just business development for them. So the first step is starting the company. Go get one of those law firms. It's Gunderson, Cooley, Goodwin. They're very easy to find. And a partner, they'll defer fees. And then always pay the lawyers last. Lawyers should always get paid last. But if you fail, you don't pay them. If you raise, then you kind of start paying your bills. But they'll make sure you have equity. They'll make sure you can grant equity to people that you hire. They sit on board meetings for free. And then the other thing is, if like you have a little bit of money saved up, or like, I don't know, mom and dad want to like lend some money, you can do that as a promissory note. Like the first check into most days, I wrote a check for 50K or whatever to just make sure there was a bank account. And then once I raised a few $1 million, you just pay yourself back. So there's no just like free money in. But a great place to start is the law firms. So you actually have a lawyer and you have a proper business and your name is on it and you own the business. And then the other place to start is the incubators. So the most famous incubator is an incubator called Y Combinator. The basic deal at these incubators is they take 6% of the company for, call it 200, 250K, which is very expensive money to raise. You're giving up 6% of your company. It's a very low valuation. But the beautiful thing with them is you're surrounded by a group of other founders who are trying to get their companies going. And so you're with all these other people who are working on the same problem, sharing information. These incubators have like a recipe. They've got a program they're putting you through. And then their goal is to help you raise money and kind of get to here. So they're going to help connect you to investors. You're not going to have a network when you start there. So that can be you don't have to go that path, but I think you'd be shocked at how much you learned if you moved to San Francisco, went through an incubator, how much you'd learn in the course of 3-6 months a year. It's a very accelerated learning, and it's well worth the 6%. Like if the thing succeeds, you're not going to care about the dilution you took then. And then if it fails, doesn't matter either. The other thing to think about here is basically, you're going from hundreds of thousands of dollars to kind of, I'd call this more like 500K to 1.5 million. These rounds tend to be like 3 to 6 million. There's a little bit of a hype cycle going on right now in Silicon Valley, people raising $100 million seeds, which is crazy. But getting here is very hard. And what you want to do here is you want to play down. So I'll give you an analogy. I hit puberty late. I was like short and skinny in middle school. And so I was right on the edge in football of lightweights and middleweights. And all of my friends were bigger than me and they did middleweights. And I decided to do lightweights. And my friends made fun of me a lot. We dominated. We were undefeated. I scored like 3 touchdowns a game. And so, because I was playing with kids who were a grade or 2 below me. And so that's kind of what you want here. There's this weird instinct that people have where they're like, I want to like act like I'm bigger than I am. And it's like, no, you want to dominate your class. You want to look like a seed when you're a pre-seed. You want to look like a pre-seed when you're a friends and family. You kind of want to be the big kid on the playground. You want to be the older kid playing lightweights and scoring a bunch of touchdowns. Because you're going to be compared to your peers at that stage, and you just want to appear like you're further ahead, like you're bigger and better. And so a lot of people will they'll call like multiple rounds seed. Oh yeah, we're just a small little seed when things kind of aren't really working, because you don't want to be compared to Series A companies. That's a hard bar to hit. But anybody in here can go kind of get here. And then it just depends on like, how do you execute and stuff. Most people in here should be able to get here. This is a higher bar, but like getting 500K, $1 million, $3 million, people in their early mid-20s doing it every single day. There are billions of dollars available for those kind of checks. And then at the end of all of this, if you get it right, you go from friends and family, you get to pre-seed, you go to seed, you raise your Series A, you raise a B, you raise a C, you're like a big fancy kind of cool person. Well, then you've just earned the right to obsess over your customers for 10, 20 years. Most businesses, vast majority, don't live 10, 15, 20 years. And so that's the dream, is to obsess over the customer, obsess over the user. So Steve Jobs didn't do us any favors. He kind of promoted this thought as a product person that like, I know what the customer wants. The customer doesn't know what they want, and I'm gonna create it and I'm gonna give it to them. And that's fine if you're Steve Jobs. Like, he was good at that. There's a Henry Ford quote. He said, if I would have asked the customer what they wanted, they would have said a faster horse. And that's fine for Ford and Steve Jobs. But in most cases, you just want to really understand the customer that you're serving. You want to know that customer and you want to build for that customer. So my view is, you're not creating something from scratch. It's like an archaeological dig. The pain point of the customer, it exists. And if you just kind of brush away at it slowly enough and carefully enough and methodically enough, you'll expose it and you can build a product to address that pain point, and you can capture the value that you create. So I'm very much not of the Steve Jobs camp. I'm very much of the know the customer, obsess over the customer. I think Amazon in their board meetings, I don't know if they still do it, they have an empty chair that represents the customer, so you can point in the meeting like, hey, the customer is not gonna want this. And so you earn the right to obsess over the customers, obsess over the problem that you solve, and then you've created something really cool and valuable for the world. You've created a lot of economic security for yourself. You've created jobs for people who work with you. You've created a bunch of amazing relationships. It's gonna kind of feel like failure most of the time. These things tend to feel like failure basically like every day until like someday when you succeed and the outside world kind of views it as being a success. But this is very, very hard. And every day Amazon's getting up. Like Mark Zuckerberg is waking up every day, like just chewing on glass, basically, like just working on really hard problems. It's not like everything is just great in his world every day. It's doing this is hard, but it probably is the highest probability path to becoming a billionaire. But I think more importantly, it's really rewarding. Like, it's really cool. It's really rewarding. And we happen to live at a moment in time that's very unique in the history of the world where like you can be in your mid-20s and somebody will give you way more money than you deserve to go solve whatever problem is interesting for you. And you can do it in San Francisco, which is fun. You could do it here too. It's just there's not as much happening here. I think I've got one more bank and one more slide. Any questions? Yes.
This is super cool. Could you give us some insights about your negotiations when you go for funding and in terms of ownership, in terms of how much wiggle room do you as an entrepreneur have? What strategies do you have? That you can take with respect to negotiations.
So when you're raising money, raising money is like I'm a skydiver. And skydiving is actually two very interesting experiences. One is when you're free falling, you're falling out of the plane and it's really loud and it's chaotic and it's kind of scary. And then the second is you've pulled your parachute and you're floating on it. That's a quiet, it's a controlled experience. These are two very, very different experiences. And fundraising is kind of like that. When you start a fundraise, you need money. You don't have anybody who wants to give you money, and you don't have any leverage. It's like, what's the price? How much are you raising? You'll kind of take anything. You have no options. And so you go out and you pitch your business and you talk about how much money you need to get to the next step. So you need to have some sense of how much money you need. But when they ask you, hey, what's the valuation? How much do you think the business should be valued at? You say, that's up to you. The market will decide. You do not answer that question. You say, you're the investor. I'm just the entrepreneur. I need this much money. The market's going to decide. Because this, in negotiating terms, it's a very tricky game because there's no like, there are some benchmarks, but it's more art than it is science, like what the company's worth. And so what that does is you're not floating a valuation that's too high, right? If you wanted the valuation to be $10 million, an investor was willing to write you a check at 7, and that's the only check you had, you'd take that check. So you don't want to take that off the table. And then 2, sometimes investors give you much higher valuations than you expect. I raised a round for one of our companies that we would have been really happy if we did the deal at $85 or $90 million valuation. And I did this, I was, I don't know, you tell me. And the investor said, he sent me a term sheet with a $150 million valuation. I had to call him and I'm like, hey, that's too high. Did you tell anybody about this? And we did the deal at 120. But on the skydiving analogy, once you have one term sheet, then now you have leverage and you have options. And now if you get 2 term sheets, now you've got competition. Now your deal might go away and you can increase the price. But you don't want to raise too high and you don't want to raise too low because you have to raise subsequent rounds based on your previous round valuation. So a lot of people right now, because it's a frothy environment in Silicon Valley, are making the mistake of the business really shouldn't kind of raise at more than, I don't know, 50 million, and they're taking money on 200 million because they're like hot, But that means everything better go perfectly, everything has to go right, or else you have to raise what's called a down round that are very hard, where you're like, okay, we raised our last round at $200 million, now we'll take money at 50 million. But I've got a friend who says, hey, the goal of a fundraise is just go get a term sheet from the Sovereign Wealth Fund of Uzbekistan. He's kind of making a joke like, just go get a term sheet from anybody, and then you're off to the raises. Then you have a canopy above your head, and you haven't landed the plane yet, but you're on your way. Because you often, once the pitch starts working, you get all no's, and then when you get your first yes, you start getting more yeses quickly. You're iterating on the pitch, and then it goes from not working to working, and you get multiple term sheets, and then you can kind of optimize the round. But the goal is don't say evaluation, and then just focus on doing everything you can to get that first term sheet. And that's just having a canopy above your head. You're not just going to smash into the ground. You're likely to land safely. But a lot of people make the mistake of like, I'm raising at this valuation. It's a classic. Don't make that mistake. Okay, one more thing. So pivoting. I've pivoted. Death clock is a pivot. So there's a famous saying in the Air Force is know the plan, fly the plan, don't fall in love with the plan. What that means is like, okay, we're going to go attack this enemy target. And so we all have a conversation on the ground. And then we get up into the air and like there's a bunch of enemy fighters that we didn't expect. Okay, you got to deal with that situation as it is. You're not still going to fly the plan. The plan has changed. And so you got to be really open to pivoting. I mean, Slack, very famous entrepreneur, this guy Stuart Butterfield, he raised money for this company for a game called Glitch. And he had, and it didn't work at all. He had $6 million left in the bank, and he went to his investors like, hey, I'll give you the money back. Or we created this tool to like talk internally. We could like see if that's a business. And his investors, this is again, the beautiful thing about being, here in 2025, they're like, yeah, sure, take the 6 million and like go do the new thing. And it turns into a $25 billion outcome. It turns into Slack, which I don't know how familiar you are with Slack, but it's like in the working world, everybody uses Slack all the time. Do you guys use Slack? You know of it? Oh, you will, unfortunately. But it's like work chat. But like, so you want to be like, oh, I never would have thought death clock is what we're doing. I never would have thought that a few years ago, but it's like, hey, there's a kind of trend around longevity and we can actually do some really interesting things in this post-AI era. And we've learned a lot from what we did before. And like, okay, so it becomes death clock. You can get blood tests. I never would have thought of it like a blood testing longevity business, but like, we started as most days, and then it's like, you kind of read the tea leaves and you pivot and you do what you can to keep your company alive, and you make it work. So you want to know the plan, you want to fly the plan, but don't fall in love with the plan. And you tend to fall in love with these things. You raise a few $1 million for an idea, you're going to be feeling pretty good about yourself. You're going to fall in love with the idea. But you got to remind yourself like, hey, I might have to throw this thing away to survive. Any questions? Yes.
Can you talk a little bit about your unicorn and how you were able to grow that and why you chose to keep it a unicorn instead of doing like an IPO?
Yeah. So the company, so it was a reputation defense business. So we helped people manage their reputations online. It just had really great product market fit. And so we kind of, well, what happened with that business was it had originally started as a business to track what your kids were doing online. And it was like $15 a month. And what we learned very quickly was that parents didn't really care what their kids were doing online. They just cared about what happened when they Googled themselves. And so we're like, okay. And we started selling that. And that just turned into like an amazing business that we didn't expect. We then pivoted yet again because there's another lesson here, which is like not all dollars are created equal. So what we were doing is we would create content. So somebody would Google themselves and they would see something they didn't like. So we had this whole team of people who would like write articles about them and publish those. So they would show up higher in search results than the thing they didn't like. And that's not tech. That's not like the value of the business. So the multiple on your revenue is going to be determined by how efficient the business is. And that's why tech companies tend to get these kind of 10x multiple would be the number you think about. And so we realized, oh, we've got like 60 or 70 million in revenue here, but like it's actually not that interesting of a business. So we built a properly scalable technology product that became a unicorn. We exceeded $100 million in revenue and it became a $1 billion plus business. The reason it didn't IPO is because it wasn't good enough to IPO. So it's hard to IPO. We weren't growing fast enough. The revenue wasn't high enough that it's kind of stayed as this billion-ish business without just kind of going through the roof and giving you enough momentum for it to be a company that the public markets want, basically. We wished we could have IPO'd it, but it just kind of topped out at $1 billion and it wasn't growing that way. But you can make money along the way. Like I sold in what's called secondary, you sell some of your equity to investors who want to buy it. And so we made money, but it's still a private company. But that's not the ultimate goal. We succeeded. We got like an A-. An A+ is IPOing. Yeah. So the last thing I'll say, if there are no more questions, is ask for help. I'm happy to help you guys. I'm happy to point you in the right direction. Like, you know, you're all better educated and you're more well-equipped than I am to do something like this, than I was to do something like this when I started. And you've got this advantage in your 20s, like people want to help. People like me want to help. We want to pay it forward. So don't be afraid to ask people for help. Make their lives really easy. You know, you want to send nice forwardable emails if you're asking for introductions. You want to make people's lives really easy, but don't be afraid to ask for help. And yeah, no matter what you guys do, I wish you the best of luck.